Ladies and gentlemen, welcome to another edition of Independent View with your host, Lobo Tigre. Our guest of the day is Lyn Alden, founder of Lyn Alden Investment Strategies. I think I got that right. Lyn needs no introduction. Everybody loves Lyn. I've got a lot of questions. We haven't spoken for a while, but you've got a new book, so let's start there. My audience, your audience, doesn't need to be told that fiat sucks. So maybe the question is, why is money more broken now than it has been for a while? Or what is the key insight here?
Yeah, so first of all, thanks for having me on. Um, I would say that an overlooked aspect is the technological aspect. And the phrasing that I like to use is that politics affects things temporarily and locally, whereas technology changes things, permanently and globally, right? So, for example, when someone invents refrigeration, that is a technology that spreads throughout the world, and it's a one directional thing. We don't go back and not have refrigeration as long as civilization doesn't collapse. Whereas any sort of change within a given country is more local, temporary, reversible. It's an issue for those people, not the world. It's not a one-way thing. And so when we look at kind of monetary history or the way money systems work, it's good to look at things that have kind of changed globally rather than be like a local issue or a temporary issue. Um, and so I think the key problem that we have faced really for the past, you can call it a century and a half, is that transaction speeds accelerated greatly compared to settlement speeds, and that heavily contributed to centralization. And therefore debasement, and therefore the more rapid politicization of money than was previously possible. So if we kind of back up a second, before the
Wait,
telegraph,
actually, sorry, let me jump in. I do
sure,
follow that the transaction speed exceeded the settlement speed. You could send a telegram, make a deal, but if you're settling in gold and that had to go by, Wells Fargo covered wagon, it was going to take a while.
yeah.
Uh, how does that contribute to centralization?
Because if you're managing that mismatch, if you're sending people money quickly, and it's tethered to some underlying settlement asset, then you're really relying on credit in the intermediate term, right? If you send money from North America to Europe in, say, the late 1800s, after the telegraph was deployed across the Atlantic Ocean, what you're really sending is an IOU. Right, because you're not beaming over the gold, you're beaming over an IOU. You're making an agreement, and it's far faster than gold can move and be verified. And so what happens is that all that credit kind of consolidates on someone's ledger. And so the telegraph was invented in the 1830s. It was widely deployed by the 1860s throughout the Western world, and then the early 1900s, kind of more globally. So prior to that kind of late 1800s period, settlements and transactions were roughly the same speed. There were various, paper instruments and analog encryption and physical banks that could make transactions more efficient, but they couldn't move at the speed of light. So they were still somewhat close together. But the invention and specifically the deployment of the telegraph and everything that followed, so telephone and internet and all of that kind of brought transactions to an order of magnitude different speed category. And so that gulf opened up dramatically. And what it does is it centralizes on ledgers. And so a really good reference for that is, and I referenced it in Broken Money, there's a book that was written in 1875 called Money and the Mechanism of Exchange by William Stanley Jevons. And it's remarkable because he's talking about, it's like he's both looking at it from a good lens and a bad lens. He's like, money's become so efficient, um, that we are setting around all these transactions constantly, and we almost never have to actually move the gold. It's just everything is beaming around, all this is happening. We almost never have to touch the gold. And he's like, okay, that's great. The problem is that the system's levered 20 to 1 because no one ever checks the system. No one ever wants to pull gold out because they lose a lot of the efficiency of being part of the system. So a lot of people don't pull their gold out, and this whole kind of levered artifice grows on top of it. Everything's moving around, everything's settling, kind of net. And in his day, he kind of showed this like multiple like trees of like, multiple layers of centralization. Every friction is finalized, is solved by another layer of centralization below it. So individuals use a bank. Banks use a central bank, and then even central banks tie into the biggest central bank, which in Jevons' day was the Bank of England. Now it's the Fed, and so that's kind of this like stack of ledgers that people turn to when they want to have all this kind of fast transactions, and there's no settlement that's moving that quickly. And so it got to the point where it all got levered, it all blew up, starting in World War I and really never recovering from there. And then they were able to just drop the settlement layer entirely, because we live in this telecommunication enhanced world. And so we've been in this kind of weird environment ever since really the telegraph was invented, where the financial arbiters have a lot more power, is basically where we've been stuck.
Okay. So I do follow the centralization. You have to have it because sort of like Western Union today, you can send money around the world. You're not actually sending the money. Another branch of Western Union is giving the person the money in the other end. The money is centralized with Western Union, and they have no risk because they got it on one end, they're giving it the other. Okay, I can follow that. But that's not new today. What's the takeaway for people today?
So what the takeaway today is that it is worsening over time, right? So
Hmm.
basically, the telegraph and then the telephone and then the internet and then mobile internet, these are all layers that just keep speeding and speeding and speeding things up. And there's still really no fast settlement layer, right, for most of that era. And kind of the way I describe it is that, when a country wanted to debase currency in the past, they literally had to like get the coins back, remelt them, and then spend them back out in greater, more diluted numbers. They're clipped or they're diluted in some way. Whereas now, with a flick of a switch, they can just debase overnight. So they've short-circuited that process. They can debase way more quickly, and so money supply grows far more dramatically in our lifetimes, right? I mean, I'm young, and yet the U.S. left the gold standard officially, like the kind of the Bretton Woods system, like less than 2 decades older than me, right? So it's not that this era is actually still pretty recent. And when the era began, the era was still relatively well capitalized, especially after the big currency devaluations of the 70s. And so the US and certain other countries had a long period where they could kind of eat their seed corn, right? They could run positive real rates for a while. They had low sovereign debt to GDPs. And so then we went through a 40-year period of in this kind of weird kind of fiat only experiment where, they stabilized things in their early 80s. We go through 40 years of, debt across the board is constantly rising, but it's being offset by structurally falling interest rates. And so if you double your debt, but you cut your interest rate in half, you still have the same interest expense. And so we had 40 years of that trend, which kind of kept a lot of the wheels on the tracks. I mean, it would blow up in emerging market X and blow up in emerging market Y, and it would slowly debase in developed country Z, right? But it was the overall structure of the system was largely on track. And what's new now is that we've bounced off zero, or in some cases, mildly negative interest rates, while debts are still at very high levels, and so you don't have that offset anymore. And so we're entering more of a structural financial repression type of environment. And then at the same time, there are technologies that now reintroduce the possibility of rapid settlement, or going around centralized ledgers. So, for example, there's 160 different currencies in the world, more or less. And all of them are local monopolies, and all of them are enforced really in two ways. One is, you can only bring value through a port of entry in limited amounts because they can surveil you bring in cash and gold and any other sort of fungible liquid monetary like asset. They can control that and have their own rules about how they want to handle that. And two, any sort of bank wire in or out of a country is obviously highly surveilled, highly controlled. Even Western Union it's connecting to different banking settlements. It's kind of bridging gaps. It's still it's a permissioned asset for the central bank. And they can set kind of artificial exchange rates, and they can kind of control those portals. And now with Bitcoin and stablecoins and things like that, if a Nigerian graphic designer does work for me, she can show a QR code on a phone on a video call or a payment string on a DM or an email, and she can request dollar stablecoin payment, gold backed stablecoin payment, Bitcoin payment, whatever she wants, and it goes around her local banking system and those two major bottlenecks. And then also, for example, someone can memorize 12 words and bring in a literally unlimited value density of Bitcoin or stablecoin or whatever through a port of entry. And so what's also new is that now the technology for going around that pretty centralized structure, sometimes completely decentralized, in some ways partially decentralized, or at least around certain centralized hubs, is also kind of chipping away at that. So now the system's running into more frictions really than it ever has before.
How do you see this playing out? I don't want to stay on the theory too long, but this is, at least for persons interested in finance going forward, perhaps the most important question of our times. How does this play out? If we have currency regime change, uh, what does that look like?
So one is I think the world becomes more multipolar. Basically in a world where um, the US is well over 100% debt to GDP, can't have interest rates that keep up with the supply growth rate of money. There's less incentive to hold their assets as long-term reserve assets. And then you add the geopolitical challenge of that they're also freezable assets, they're permissioned assets. So there's more incentive to either diversify your holdings, to hold gold, to make deals to, you instead of buying treasuries, you buy more liquid asset like rights to a commodity deposit or some sort of shipping infrastructure, whatever the case may be. Those types of things become more common. The more bilateral trade agreements, they're filled with frictions, but that's kind of this like slow change that's happening. So that's number one. Number two, I think the long tail of smaller, weaker currencies become increasingly less tenable because there's more ways for people in those regions to get out of them. They're less trapped, and therefore the artificial ability to kind of enforce that is diminished. And so, for example, I mean, there's like 40 currencies in Africa, there's like 30 currencies in Latin America. All of those are frictions. Uh, Most of them are not something that anybody outside of those jurisdictions chooses to have. And so that's why things like when you look at chain analysis does who they look around and says who holds crypto, and really by crypto they a lot of times they mean stable coins and Bitcoin. It is really concentrated toward the top handful of things, and it's really it's the Argentinas of the world, it's the Nigerias of the world, it's the Vietnams of the world. It's basically any place that's reasonably tech savvy and that also has an undesirable currency situation. And so I think the long tail of smaller, weaker, more rapidly debasing currencies get increasingly challenged because now there's a reintroduction of choice of money into most of these jurisdictions, unless they close themselves off entirely, like North Korea or something like that. As long as they're somewhat open in terms of telecommunication, it's harder for them to maintain a currency monopoly.
That's interesting. I hadn't thought of it this way until just now that you said that. But we could actually see the dollar's share of reserve currencies globally increase as these other currencies shut down. So even if Bitcoin is or gold is stealing more and more of the pie, dollar could also steal more of the pie if people just don't want Argentine peso. I mean, if Milei is successful and he does dollarize, and there's a whole bunch of African currencies that deserve to go the way of the dodo. If that happens, right, we could actually see this trend towards lower dollar reserves globally reverse.
Well, yeah, there's been some writing on and some analysis on this. Basically, even as to your point, even as top-down countries try to de-dollarize around the margins, there's no de-dollarization effort from the bottom up, right? So when you
Right.
go to the cash street markets in Cairo, it's really dollars. It's not, Chinese yuan, for example. It's by far the most liquid, most desirable market there. That's true for most countries, at least outside of kind of China's orbit. Um, and if you look at stablecoin volumes, you can make a stablecoin for any fiat currency, really, but like over 99% is dollars, which is a higher ratio than any other, when you look at reserve breakdowns and things like that. So basically, it kind of is dollarization from the bottom up, even as you have gradual de-dollarization from the top down. It's gotten to a scale that people have noticed. So it's been written about, it's been talked about. Uh, there was a recent interview with former speaker Paul Ryan. He mentioned this. So it's now it's in the government zeitgeist. It's in the Wall Street zeitgeist. It's becoming known. I think it's still not widely understood. The question is how, it only really matters at scale. It's stable coins are over $100 billion now, which is scale, but $1 trillion is real scale. Um, and so that is a factor that there's more choice of money. People can buy dollar stable coins, they can buy gold stable coins, they can buy Bitcoin, they can buy cryptocurrency XYZ. Now it's a more open, there's a marketplace for money if you find yourself in Nigeria, in Vietnam, in Argentina, there's more choice of money outside of your monopoly.
All right. And not to pick a fight here, and I like the multipolar world. We don't need to decide which money or which currency is going to rule them all in the end. Let the market decide is my view. But walk me through this. Okay, Bitcoin solves this, right? But Bitcoin also solves the difficulty of transferring gold ownership or rather the blockchain solves it. So gold now is really as instantly liquid, like actual real ownership of the gold is available at the speed of light now as well. So if I have a choice between, some kind of crypto token that's backed by nothing, it's just is what it is, even if it's limited in number, and I have something else that's backed by, it's basically a modern age commodity money. And why would I choose the one that's an abstraction versus the one that's backed with something solid in a world where I have these choices?
Sure, a couple reasons. One is that the gold-backed token is a credit IOU. It basically there's a gold custodian holding it legally, and then they issue tokens that are redeemable in some ways for it. So you still rely on a centralized chain of custody. The same is true for dollar stable coins. Basically, but that doesn't mean they're not useful. Basically, what it means is, let's say you're in Argentina, you don't trust the Argentinian banks, you don't trust the Argentine government, but maybe you trust Switzerland, right? So they can custody gold, they can issue tokens, and then you can hold or dollars, or you can basically whatever the asset of choice is. You're trusting a centralized hub and a chain of legal credit, but that hub is outside of your jurisdiction. So you're outside of the jurisdiction you're concerned about, which is generally your own troublesome jurisdiction. So it's a permission thing that Switzerland has to allow or the US has to allow, whatever.
Or sorry to interrupt, but inside or outside, it is a physical location. And if governments
Yes.
decided they didn't like it, like if you
Yeah.
stored this, if this was backed by gold in Brink's vaults around the world,
Yeah.
those are still physical vaults in the world that governments, if they decided
Yes.
only criminals and pornographers or whatever, child abusers, only they use gold-backed cryptos, we're going to shut it all down. They could
Exactly.
seize those vaults. Whereas something that's purely distributed, built into the internet or whatever, that can't be seized by a government.
Or at least it's much harder. Basically, there's no central node. It's distributed around the world. There's various points where you can try to chip away at the centralization. So, for example, supply chains for the processors that Bitcoin miners use, or trying to confiscate their mining machines,
Well,
or
but does
trying
that
to.
matter? I mean, we're already at the point of almost, the marginal return for mining now. We're close enough that, we're not going to be mining that much more. I guess it will take a while till we get where we switch over from mining for proof to another regime. But sorry to interrupt, but it just strikes me as like the mining is almost done. Most of the Bitcoins that are ever going to be made, they're already made, right?
Well, yes, but there's also transaction fees. So if you want to send it around, you pay miners to include your transaction in the next block. So the faster you want your transaction included, and if there's congestion, you pay more for it.
Mm.
And so, for example, especially if 10 times more people decide to use Bitcoin 10 years from now than are currently using it, probably the average fee will be higher. And so basically, miners are going through a transition from most of their money comes from new coins to most of their money comes from transaction fees over call it the next 10 years. So the mining centralization or the mining decentralization, as it were, is still an important variable. So yeah, it's not perfectly decentralized across all metrics, but all of those are pretty sufficiently decentralized, which is one of its points of
Okay,
comparison.
so
And the other, yeah,
So sorry, just for clarity, the point is that whether they're mining or whether they're getting paid for transactions, there's still a vector for attack for conventional authorities to go after them at that point in the system, right? Is that what you're saying?
it's just much harder. I mean, and for example, China banned mining in 2021. The
Again?
machines, yeah, again, this time they actually tried this time. And so there used to be the majority of hash rate in China. They did like their eighth ban or whatever it was. This time they actually stuck to it a little harder. So machines kind of they went to Kazakhstan, they went to the United States, they went to Canada, they went to Norway, they went now they're building out in Africa pretty well with companies like Gridless. They dispersed elsewhere. Ironically, China's still like roughly the second biggest mining jurisdiction because it's hard to fully ban it. But basically, it kind of moves away from wherever there's frictions or problems. Um, and so, yeah, there's basically it's so far the most decentralized way we have to mitigate any sort of central point of failure. That's at least the design of the system. 15 years, it's been successful. We'll see what it looks like for another 15 years. But that's kind of the main selling point of something like Bitcoin compared to, say, gold-backed stablecoins, in addition to the fact that if you look at the amount of tons produced per year at current prices, there's something like $2.5 trillion worth of gold going to be coming to market over the next 10 years. Whereas at current prices and production rates, there's something like 70 billion worth of Bitcoin coming to market. So obviously price of gold and Bitcoin can change to accommodate any sort of flows that occur or don't occur. But basically it's also got a lower money supply inflation rate than gold. So in addition, along with any sort of other pros and cons that it has.
All right. I really didn't want to go too far down this rabbit hole, but I got to ask real quick. We also have the crypto community like really embracing regulation. They want to be welcome to the parties of all the posh places on Wall Street. And this kind of runs counter to the whole ethos that I liked about cryptos in the first place. I'm not the only one to say this, but to the degree that we have more of these ETFs, more regulated products, or the underlying technology itself embraces regulation, does that not open it up to more attack?
So I think it's one of the vectors of potential centralization to watch. There was already before the ETFs, there's already over 600,000 coins in Grayscale, for example, and so a lot of those are now just spilling out into other ETFs. Now that there's cheaper options like BlackRock or whatever that also have a lot of marketing power. So we are seeing a small growth in the number of coins that are in ETFs, but largely it's a dispersion of coins that were already in ETF-like structures. Um, and the way I would put it is that, you know, any asset that reaches $1 trillion of market cap and is liquid is going to get ETFs made for it. That's just like it's going to be how it works. There's already, even before this, there were ETFs outside of the US. Now there's just ETFs in the US. Um, Within the space, there are different thoughts on it. Some people embrace it. Some people are, not thrilled with it. But I think it's one of those things that regardless of where someone sits on it, it's inevitable that ETFs are going
Okay,
to be made
but
on
the
it.
question isn't really about the ETFs. It's about embracing regulation. And does that not make the overall system and or community more vulnerable?
If people change Bitcoin to accommodate regulation, sure. But that's not really happening. It's basically there are pools of capital that are decided to buy chunks of Bitcoin. Um, but right now, the development is global, the holding is global. For example, like you can hold coins that are not in ETFs or any sort of like walled garden environments. So basically, some people like it because there's trillions of dollars held by advisors and retirement accounts and other kind of like walled garden capital that can now flow into Bitcoin and increase the price of Bitcoin. So some people like that aspect, whereas other people are like, no, I'm here for the freedom. I'm here for holding my own keys, being able to bring my coins with me anywhere in the world or sending it to anyone with an internet connection, and all that. And so, I mean, for next, in a couple weeks, I'll be at the Oslo Freedom Forum in Norway, and that's not a financial conference. That is a human rights conference for people that deal with authoritarianism around the world. And they use things like stable coins and Bitcoin because, if you're trying to run like a anti-authoritarian thing and your bank accounts are getting shut down, that's a tool. So right, that's why I put focus on those more I would call them fundamental use cases for the technology, the right to choose your own money, the right to self-custody your own money, to move money around rather than everything being some kind of top-down, centralized, surveilled, permissioned environment.
All righty. Okay, going from theory to investment practicalities in days, is there a takeaway? Like big picture, I see the case you're outlining going forward, but right now, if I'm looking at this trend, how besides buy Bitcoin or whatever, how do I make money based on the realities that you see unfolding, say, in the next year or two?
Well, the next year or two, I've been bullish on gold as
Like
well.
not tomorrow, right? I'm
Yeah,
not I'm not pinning your feet to the fire on some immediate, don't give
yeah.
me this hot stock tip, Lynn. But just like if this is really happening, what changes, not someday, whenever, some when, but like, a reasonable time frame could I bet on?
Well, I was saying so if one was if one bought into that thesis, obviously buying Bitcoin is one of the options. Investing in companies doing anything in the space is another option. The handful of companies that are successful in stable coins, they're printing money right now. They're making a ton of income because they're holding treasuries, and then they're issuing tokens that pay no yield, and they're collecting the spread, much like a bank, basically. So there's a number of ways, basically people that make exchanges, people that own the best assets, people that kind of operate in the space. That's one way. Another way is to kind of scan your investments and to say what could be disrupted by this over maybe not a year or two, but maybe over the next 5, 10 years. What is on the wrong side of this trend should it get 10x'd, for example? It got 10x'd over the prior number of years. It's still fairly small in the grand scheme of things, but what if it 10x's again by the early 2030s, for example? So you want to scan for a negative outcome, I think is another takeaway. But yeah, as far as overall portfolio construction goes, what I do is I own a number of diversified equities. I own precious metals and kind of commodity producers of various types. I own Bitcoin. I own, say, short duration things like T-bills or TIPS, rather than long duration bonds. That's kind of the breakdown of the portfolio I have. A couple trends I'm watching are, potential floors in, say, Latin American equities or emerging market equities broadly. There's certain reversals that could be gradually underway. So there's trends like that I look for. Is kind of how I take it. Basically, I think that for the next 1 to 2 years and the next 10 years, we're under a structural fiscal dominance regime, which is generally higher average inflation than, say, we were accustomed to in the 2010s decade. And that has certain implications. Basically, you want to own scarce things. You want to either short or avoid abundant things like something like there's 20 trillion in US government securities estimated to come to market over the next 10 years. That's the CBO's estimate. That's usually an underestimate. And so it's basically avoiding things that are just fire hoses of supply for the foreseeable future.
All right. Well, you brought up those words, fiscal dominance, and that's one of your themes. So let's go there. For anybody who's not clear, what's the 30-second, or not 30 seconds, but what's the short definition here, and why is fiscal dominance important?
Fiscal dominance is when the fiscal spending, fiscal deficits become a much larger impact on the economy than bank credit. And that the size of the debt and the deficits of the public sector become large enough that central bank options become constrained. They're less able to act independently or to fight inflation because their tools are almost entirely geared around trying to get banks to lend more or lend less, which is, back in the 70s, for example, that was the dominant factor in kind of determining the rate of money supply growth. But if you have fiscal deficits that exceed the amount of bank lending that's happening in the entire economy, and central bank tools do not really impact that much, if at all. Sometimes they even make it worse. Like raising rates makes the deficits bigger when you have 100% debt to GDP that is interest bearing. And so the tools become less effective, and just certain things in the economy work differently than we've been accustomed to in a more monetary dominant environment.
Do you think the Fed knows this but just won't admit it? Or are they actually blindsided? They have said, several Fed chairs going back, they all say, oh, yes, we have the tools. Don't worry. If we have higher inflation, we know how to crush it. Right. And yet, um, it, who could have foreseen, the trillions and trillions, the $1 trillion deficits that we've had and all the money as a result of the COVID lockdowns and so on? Uh, I guess libertarians could have foreseen it, but they didn't. But the argument for fiscal dominance and just the fact of the limited impact of monetary policy, it seems like they should be reconsidering their premises, but it doesn't sound like it. It sounds like they just keep saying, yep, we're in control of this. We got it from 9% to 3%, so everything's fine. We've got this.
Well, so part of it is a confidence game. You'll never see a central bank really predict a recession or say they don't have control of the
Except for
situation.
Andrew Bailey recently.
Yes. Yeah, it's rare. Let's say it's not never, but it's just rare. And so a lot of it is just looking like you're in control, looking like things are fine, because you don't want to be the self-fulfilling prophecy that accelerates the issue, right? So that's number one, is that you're not really going to necessarily get straight communication from people, even if they do get the problem. The second answer I would say is that, so I've talked to some central bankers, or institutions that they talk to central bankers. In general, I think it's a mix. I think that some of them get the idea. I mean, like, I think it was the St. Louis Fed. One of the Feds published a really kind of well known document about fiscal dominance, and the issues that it causes. So it's not like they've never heard the term. I think one thing that some of them disagree with each other on is how far along the path are we, right? So a lot of them will say, well, look how far Japan got before it was an issue, right? But I think what they're doing there is they're picking the most outlier case, the one that went into that situation with the most like harmonious society in the world, basically, and then with a structural current account surplus, a huge positive net international investment position, during a structural commodity bear market, which reduced inflationary pressures. That's kind of is basically like the perfect scenario to go into that problem with. And everybody thinks that they can push it as far as Japan did before it becomes an acute issue. I would say it's become an acute issue for Japan now more than it ever was in the past. And I think most countries will experience the issue before Japan does. There are various things that can accelerate it, which is having a current account deficit, having a higher price environment for commodities due to insufficient capex in the prior cycle. It kind of goes through these, call it 15-year cycles. So if you do this in a commodity bull market cycle, it's going to be harder than a bear market cycle, which Japan enjoyed in the 2010s. So I think that's where some of them all see it differently, which is everybody wants to think it's the next person's problem or the next person's problem. They don't really want to say it's their problem. They all say, look, these fiscal situation's unsustainable, it's got to be corrected, but it's not an issue in the next 2 years. And I would say it's slowly been an issue ever since, call it 2019, is where I would kind of draw the line. But it doesn't mean everything blows up in 2019. It means that markets slowly start working differently, and central banks have to kind of bounce around liquidity issues in the sovereign bond market and things like that more regularly. And so things slowly start to change and increasingly become an issue as each year goes by.
So do you think the Fed ever admits that it's made a mistake here and it has to change policy accordingly? Or do they just, let the wheels come off a bit and say, oh, recession, so we have to change policy and never really address fiscal dominance at all?
Um, I mean, it depends on the central banker. I mean, Janet Yellen, when she left being Fed, she said her biggest regret was not causing more inflation. She's on the record for that. She's like undershot her 2% target the way they
Yeah.
measure it.
Well, I mean,
Pow
I'm just thinking about it. Sorry, let me add to that because I'm thinking, Powell, if I'm not mistaken, I remember him saying in answers to questions, like they're not worried about the debt payment. Like that's not an issue. It's not a problem. These charts of, I think somebody interviewed him within the last few months about, and that was a question, like when the debt payments exceeded national defense, and that was making headlines everywhere. And somebody asked him about that. And he's like, no, it's not a problem. And at some point, that obviously is a problem. And so I guess, I can't ask you to predict what the Powell is going to say or do. But you are a student of history. Can you see a scenario where they, admit the obvious facts, or do they just pivot on some other basis? Or actually, who cares what they admit? How do you see this playing out?
So I think that so we've seen somewhat of it playing out recently, which is they've been hesitate to keep raising interest rates, even though inflation's still above their target and not even necessarily heading in the right direction. So they've pushed out their speed with which they want to cut, but they've not really committed to higher rates. Ever since the bond market got wobbly, ever since the banking system got wobbly, basically the lesson of history is that they almost always choose the sovereign bond market and the banking system stability over inflation. If those things collide, they will try to manage both, but at the end of the day, they're not going to let a bond auction fail, twice in a row. They're not gonna let just like this cascading bank instability thing fester. They're gonna put out that fire even when inflation's above target. And so
I
that's
mean,
kind of
well,
the
we did see that last year, right? We had
yeah,
those three big banks, and they responded. It wasn't some small thing. Opening up that facility to any bank at par, that was a huge
yeah,
emergency level move, in my view.
yeah,
I guess you're probably familiar with what's his name, the liquidity guy, Michael Howell, his
yes.
work and his global liquidity thesis. I was dialing into something that he said, and I don't know where he gets the data, maybe you know, but he was saying that the Fed's QT only looks like QT, that on a line item basis, that not all things really affect liquidity the same, and that the kinds of things that actually increase liquidity, they're not tightening up on at all. And in fact, they've increased liquidity to the market. And so he sees this as an argument along these lines of sort of surreptitiously trying to prop the system up. Do you see that as well?
I do. The way that I measure liquidity is basically been sideways ever since they had the banking issue, and really ever since they had the gilt blow up in say September October 2022. And so basically for a while there, like during most of 2022, liquidity was going down. They were doing quantitative tightening, and there really were no offsets. Once they ran into so late September of 2022, the dollar index spiked. The U.S. Treasury market got kind of illiquid. It was not doing well. This high move index, like high volatility, the gilt market just blew up. And so the Bank of England came in with emergency kind of temporary QE, and the Treasury, it was not the Fed, but the Treasury started to drain their Treasury General account, partially because they ended up having a debt ceiling issue, but that's the way
Right.
they timed it. That's a pro liquidity move from the Treasury. So that was like the bottom in liquidity, the top in the dollar index, and kind of the temporary worst part of the bond market issue. So then they sailed around this more sideways situation because you had a falling TGA offsetting Fed QT. But then that became insufficient in early 2023. So the banking system started to have issues. So then, like you said, they did all these temporary, kind of intermediate term, liquidity injections to offset that. And they started drawing down the reverse repos. Basically, it got to the point where reverse repos stopped going up. The Treasury was issuing a lot of T-bills. Basically, the lever they can pull is that if they issue more short duration debt, especially when they have those reverse repos built up, they can kind of pull liquidity out of reverse repos and back into the banking system. And so between reverse repos, via shortening the debt duration on average, by managing the TGA account up and down when things get messy, the Fed now tapering their balance sheet reduction, all these tools that basically maintained it so that liquidity has really been flat ever since the late 2022 or early 2023 period.
All right. So back to the how does this play out question, it seems to me that an important issue right now is that we're just now getting to where base effects are rolling off, whether it's PCE or CPI, whatever, super uber core, whatever they want to pretend is the most important metric today. We're there. Like we are getting, it's like 11 months now. We're getting to where base effects are going to really go into reverse in a big way. And it seems like nobody's talking about this. It's going to make your monthly inflation prints that we have now, if they stay, even a 0.2 is a big problem when you don't have base effects. So the victory laps that Team Soft Landing is taking on beating inflation are, I think they're about to seem very premature. So but then if we're also faced with these, the fiscal realities and the problems of raising interest rates on that, it seems like we're close to it. An emperor has no closed moment. But we felt that way before. If memory serves, present company included, we thought that going from 0 to 3% would cause things to break, and it hasn't yet. So how do you see this playing out? Here we are. Does something break, or is there a chance they can actually thread the needle here? Or I know this is a crystal ball question, Lyn, but not 5, 10 years from now, it seems to me we're at a place where the rubber is hitting the road now. How do you see things playing out over the next year or two?
I think a series of mini breakages. I think those things I mentioned were mini breakages. They caused a liquidity response from either the Treasury or the Fed, depending on which one it was. And those contributed to inflation staying higher than their target. So, for example, if they had let bank deposits go bust in early 2023 and basically say, look, you were an unsecured creditor to an insolvent bank. Sorry, you lost money. You get a reduction in the broad money supply and you kind of quell inflation in that. But the consequences are too painful for that, and so they erred on the side of no, don't let bank deposits go away. Protect those, even if it means inflation is going to be sticky around for a while. So one, we've already seen a small number of breakages along the way, and so back in 2022. When, kind of they started to tighten, pretty aggressively in early 2022, I did not really expect them to really get much higher than 3% before they have an issue. I was like, we're headed toward recession. It's bad for asset prices, X, Y, Z. That was the case for much of 2022 until that kind of fourth quarter period where they started to kind of put a floor under liquidity. They didn't like the consequences they were getting anymore. And in addition, the short duration the duration of the government debt is on average shorter than the duration of the private debt, especially in the United States. And so that actually started to increase the US deficit, which ironically has somewhat stimulatory effects, faster than it increased the pain that it gives to private sector debt holders. And so by late 2022, early 2023, I was like, no, things are actually pivoting now. The thesis is now changing. So the way that I do it is have a broad structure, which is informed by history and just understanding how the system works. But then for exact timing, respond to things that are actually happening in practice. So ever since that kind of early 2023 period, it's like, no, this is getting interesting now because now we're more firmly in fiscal dominance. We've kind of gone through the looking glass where tightening is not necessarily the tightening you think it is, and it's a different environment. So to answer your question, so I talked to some institutions. The idea of fiscal dominance is becoming more widely understood. So that's part of it is like not only what is happening, but who knows what's happening. And the answer is more and more kind of large pools of capital know what's happening. The New York Fed is projecting that their balance sheet's probably going to bottom in 2025 and then start gradually heading higher, roughly at the rate of nominal GDP growth to maintain kind of roughly constant balance sheet relative to GDP. That's their estimate, which I think is probably fairly accurate, at least for that floor level and that rough timing, give or take 6 months in either direction. So I think where it gets interesting is if the balance sheet starts going up at a time when inflation's still above target and the Fed can't really explain why. I think that's it doesn't mean I think everything falls apart there. But I think that represents another breakage where it gets harder for people to kind of ignore it. Right now, to your point, like Michael Howell said, liquidity is not really going down anymore, but it's all these wonky reasons like the TGA going up or down or reverse repos spilling back into the banking system. It's kind of like off the radar. Whereas if that's all cleaned up, which probably by 2025 it mostly will be, if the actual Fed balance sheet itself starts increasing again, because they have to kind of maintain liquidity in the system, even when inflation is say 2.5% or 3% or higher, whatever the case may be, it gets increasingly hard for them to explain it in a similar way that an emerging market, when they have just kind of structural inflation, it's hard for them to explain exactly why it's happening, what they're going to do about it. And people say, I want my currency elsewhere. I think that in over the past year, people kind of lost faith in Japan to at least their currency. And I think you could see a similar thing to the dollar next year, the year after. It doesn't mean, Japan didn't hyperinflate. Japan's still there. It's just that the structure of the market changed and more people were like, I don't see how they're going to get out of this.
All right. So we only have a few minutes left before I think both of us have another interview or something. So quick question to wrap this up. You've talked positively about both gold and Bitcoin. Both are at least nominally at record levels. We've got 71 last I saw for Bitcoin, 2,400 last I saw for gold, 24 and change. People call these record prices. If you're counseling somebody who's looking to buy, do you really feel comfortable telling somebody to buy something that's just risen to a record level?
As a part of a portfolio, sure. I don't really recommend people ape into 100% any asset. The way, you can kind of,
Sorry,
yeah,
you're talking to somebody with white in his hair. Ape in, that's a meme stock
yes.
reference?
Yeah, people that kind of just go all into a given asset and don't have any sort of risk management in place. So usually what I do is I kind of characterize, I say, look, I don't know what it's going to do for 3 months or 6 months or maybe even longer sometimes. But here's a number of characteristics for why I think over, say, a 3 to 5 year period is likely headed higher. And my time period could change a little bit based on the asset. So for Bitcoin, for example, I'm bullish over the next 2 years. Um, to start with, and then we'll see, long term, I'm also bullish, but kind of that 2 year time frame is been something I've been kind of focusing on. Um, Gold as well. Whenever you have that kind of quick move, I do get a little nervous. But the lesson I've learned over the past decade or so is my error tends to be selling things too soon or saying, okay, it's a little bit overbought now. Um, and whereas like if something is a structural trend, it really helps to just let it run. So gold is not much higher than it was in say 2011. It's not soaring relative to stocks, for example. It's finally having a nice breakout of a very long trend. And sure, it might be locally excited, but still not a lot of people are talking about it. Someone posted on Bitcoin in the Reddit for investing, and they got flamed. No one, everyone's like, no, don't tell us the Bitcoin thing. Or like, there was a guy that spoke at a big university commencement speech, and he mentioned Bitcoin and got booed by by all the college kids. So I'm not
Really?
su yeah,
Wow,
he
young
did.
people boo you.
Yeah. So I'm not super concerned around sentiment in our spaces. People are focusing on gold and Bitcoin, but I think if you go to, it's spring and summer. If you go out and say, what's the price of gold? What's the price of Bitcoin? A lot of people won't be able to tell you. So structurally, yes, I'm bullish on those assets. I think that they're worth owning as part of an asset mix. But it doesn't mean that you shouldn't be careful around setting expectations. You shouldn't buy it and be disappointed it went down in 3 months, or that this the only thing you bought, or that you bought it on leverage. I wouldn't recommend um, not having any sort of risk management in place.
Okay. All right. Lyn Alden, thank you for your time and your insights. And just really quickly, lynalden.com. Is it better for you if we buy your book there or go to Amazon, or what should the audience do who loves you, wants to help out?
So I link to Amazon and elsewhere. So anywhere you want to buy it is great. And yeah, check out Broken Money.
All right. Well, thank you.
Thank you.
Thank you for watching this edition of In the Pit with Lobo Tigre. If you enjoyed or found value in what you just saw, and you're watching this on any sort of social media, please do hit the like button and the share link. Send this on to anybody you think might be interested. That helps us out a lot. If you're watching this on YouTube, please do hit the subscribe button as well. The number of subscribers helps us get more valuable content to you as well. On the subject of subscribing, I'll quickly say that if you're not a subscriber to our free weekly Speculators Digest, I encourage you to sign up. I promise if you do, we will not send you a flood of daily advertisements. You get one free weekly digest with original research not published anywhere else. Check it out at independentspeculator.com. Thank you and have a great day.